Okay, well, welcome to today's webinar. Let's go ahead and get started. A bit of a delay there, but I think we're up and running now. So, our webinar today is key performance metrics for cannabis retailers. So, the audience for today's webinar is retailers and brands, 2 to 20 million in revenue, but really the information that we'll share today is relevant for really anyone in the supply chain as well as uh, service companies that are helping cannabis companies grow more profitable. So we'll be diving into all of the relevant KPIs. Just to define it, KPIs are scorecards. If we monitor correctly, that can predict financial results, and we'll go into the key accounting core concepts like the importance of financial statements and how to organize your financial statements, because ultimately we want clean financial statements for stakeholders, whether that's banks, investors, and vendors. And so the information that we share today will be very empowering as well as help you organize your financial statements. So again, just to introduce myself, I'm Guillermo Rodriguez. I'm the lead virtual CFO in the cannabis space here at Virtual CFO by Anders. I'm also the host of our new Cannabis Success Show. So a shameless plug there for our podcast. And we bring in great guest cannabis operators. And really the purpose of the show there is to share what's working and what's not in the cannabis space. So we want to really bring in stories of success. And that's a lot of what we're doing today is sharing what are the concepts, the metrics, and how to be successful, be profitable, and grow cash flow. And so we have a great co-facilitator here for our webinar today, Brett Adams. Brett, could you just do a quick introduction, tell us a little bit about yourself and how you got to work in the cannabis space as a virtual controller?
Yeah, so I'm Brett Adams. I'm a CPA here in the state of Missouri. So I have over 10 years, over 12 years experience in the accounting industry. And I really started in the cannabis space when I had a friend who referred me to a company. They were a group of investors looking to open up a dispensary here in Missouri when they first legalized medical. So they were trying to apply for license. Obviously, the licenses are expensive, as everybody knows, and they just didn't have the money to just kind of throw at the license. So they went to a group of angel investors, and they were willing to put up the money, but they wanted to see some financials, some numbers and stuff like that behind it. So I put together a group of pro forma statements and projections and stuff like that, grouped a whole bunch of data and everything from grow rates to harvest rates to, all that kind of stuff, and put all that stuff together into a financial package for them. They then took that to that group of investors, and were able to get funding for their license. They ended up applying for the license. I don't think they got it, but obviously that's a competitive market. So that wasn't really a big shock. So, but it was a lot of fun. I had a really good time. I learned a lot going through that process, and kind of got a little bit of a passion for it. So,
Thanks, Brett. And yeah, as you mentioned there, a lot of what we do as accountants, CFOs is the foundation for what we're talking about today is financial statement forecasting to be able to look into the future. And it really starts all the way back in the licensing processes, as Brett mentioned, whether it's a micro license or regular license. The first step in that process is building a financial statement forecast. So you could actually use the information that we're talking about today to better understand how to build a financial statement forecast, whether it's from a business that's up and running or for a license process, as was kind of what Brett mentioned there. So let's go ahead and move on to the next slide, Brett. And then we can just kind of keep moving from there. So we'll have a Q&A function there. Please use the question function and we'll try to answer questions as we go. Or if we get a lot of questions, we'll kind of bucket them at the end and try to answer all the questions. So just make sure you use that. At the end of the webinar, we'll replay the slides and we'll pretty them up and get them sent out to you over in a PDF. And so let's go move over to the next slide. Just some history here about Summit Virtual CFO by Anders. We started as a traditional CPA firm in 2002, offered CFO back office accounting services in 2004. In 2013, we became a fully distributed team. And in 22, just 2 years ago, Summit joined Anders, and we're now Summit Virtual CFO by Anders. We're virtual CFO team plus Anders, and we have a brick and mortar office in St. Louis, but as well as a fully distributed team. So let's go over our agenda. Before we get to the agenda, let's go back to the profit-focused accounting, Brett. Before we get into the agenda, we're going to be talking today about forward-looking information. So as accountants, we look into the past, but our mission has been to change the way people think about accounting. And one way we have done this is through these presentations by educating and helping our clients understand how their financial information can help them look into the future and make more empowered decisions, week-to-week decisions about the business to help drive profitability. And we do this by breaking revenue down into non-financial drivers. We'll talk about that in our metrics buckets. And we want to consistently apply this into clear metrics, keep this very simple. So the information we present today will be very simple. And we want to be able to come up with a revenue forecast. In the end, our very last piece of the presentation, we'll talk about pipeline and how you can use the information, your customer metrics to be able to look into the future. So this is the concept of a leading indicator and a lag indicator, whereas when we'll look at financials, we're talking about the past, but a lot of these metrics help us, they're lead indicators to help us look into the future and be able to pivot and maybe make better decisions about how much inventory we're carrying, how much cash we're carrying to make better decisions. Okay, now let's go into our agenda. And so we have four main buckets. We're going to talk about cash, and you can just keep rolling through these, Brett. They'll pop up on the side. How much cash should you keep on hand? What type of bank accounts you want to have, as well as production. So production is our sales data, basket size, discounting, and pulling levers. And so the concept today here is that the metrics will help you determine what levers can you pull. Can you change your pricing? Can you increase the amount of inventory that's on hand? And these are levers that you can control based on this information. Financials is looking into the past, but we're going to go over how to organize your financial statements. You don't necessarily have to do this for an audit or something like that. This is just some concepts of how you can organize your financials and what your gross margin should look like. And then finally, we'll go over the customer metrics, looking at the lifetime value of customers and how that can help you determine where to spend your marketing dollars, as well as help you with your financial statement forecasting. All right. So moving along, let's go ahead and turn it over to Brett to go over the.
Yeah. So I'm going to jump into the cash portion of our presentation here. As we all know, capital markets are still challenging. They're actually challenging for a number of industries, right? With the pullback of interest rates and things like that, banks really tighten down on their financing. So it's really difficult to find some of that financing now, whereas just even a year ago, 2 years ago, I mean, cash was flowing out of some of those institutions like water, right? It was easy to get lines of credit, and cash was it was abundant. Not as much for the marijuana industry, just because of the nature of the regulations and stuff like that that are in place at the federal level. So even more so now, things are challenging, and so cash is definitely precious for sure. So we have some metrics and stuff like that here that we follow for all of our clients, and that doesn't change in the cannabis space. So how much cash did you keep on hand? We actually recommend that people actually have three bank accounts. So we want you to have your main operating account. That's where all of your normal inflows and outflows are going, all your revenue and expenses and everything. We want you to have a cash reserve account. And so we'll talk about more about that here in just a minute. But then we also want you to have a tax reserve account. So you should have those three accounts, and they should all have a certain amount of tax in them, bare minimum at all times. For your operating account, we want you to have at least two payrolls in that account, right? So we want to make sure that you have a cushion there that if for some reason something happens, you're not your sales aren't what they were over the past couple of weeks, and you need a little bit of cushion. You have at least two payrolls there to carry you through, a couple of weeks, sometimes 4 weeks, depending on your cadence of payroll. For your operating account, we want you to have a minimum of 10% of your annual revenue in that account. So that could be, if your annual revenue is $2 million, we want you to have $200,000 in that account. That just carries you through all of those. It gives you a little bit of cushion, carries you through some of those low months. There's ebbs and flows to every industry, and the cannabis space is not a stranger to that either. Another way you could put it would be 40% of your forecasted gross profit. So ordinarily, we would say 40% of your net income. In the cannabis space, obviously, expenses aren't deductible. A lot of the operating expenses aren't deductible. So we're just looking at your gross profit, which is your sales minus your cost of goods sold. That would be the number that we would target for the 40% mark for our cannabis clients. So let's put some numbers to that, right? So if you had $12 million cash on in total sales, we would want 10% of that on the low end. So we would want $1.2 million in that account, and then $3.6 million on the high end at the 30% mark. So when should you shoot for 10? When should you shoot for 30? It kind of depends on it kind of depends on your business, right? So if you have high recurring revenue, retailers, your revenue is all constantly recurring because your sales are constantly coming into the bank account. If you are more on the production side and you're wholesaling to somebody, then you probably want to hedge towards the 30% because you're dependent upon those businesses to pay you for your product. And sometimes businesses aren't the best to pay, right? A lot of times there's a net 30 on those invoices, net 15, in some cases even net 45. And then sometimes clients just pay when they want to pay, and you may not get the money until 60 days later. So we would actually push you up into that 30% mark for those industries, 10% if you're on the retail side, because you're constantly churning more revenue out. Also, if your growth potential, right? If you are constantly growing, you're adding new people all the time, we want you to have a little bit more cushion there, right? It gives you the opportunity to go in there and hire those people that you want to hire, and make sure that you have those the cash to be able to make those moves that you want to make. And if you're just kind of rolling along and growth is steady, but you're not really pushing to grow at an exponential rate, you're probably better on the 10% mark, keeping that amount of cash in there. The other would be if you have high personal liquidity, right? If you have a bunch of cash and you say, look, I've got, the ability to put cash into the business to cover any down periods, you're probably okay on the 10%. On the flip side of that, if your personal balance sheet isn't the best, you don't have a ton of personal liquidity, and if cash doesn't come in, you're sunk, probably want to hedge towards that 30% mark on keeping cash in the bank. So we talked about this a little bit, kind of circling back to that. We want you to have three bank accounts, an operating account, which is where your normal ins and outs for your revenues and your expenses are coming in. You have your cash reserve, and that's typically put into like a high yield savings account or something like that, just so you're earning a little bit more money on that cash. And then your tax reserve account, got to make sure we're keeping the tax man happy. We're constantly putting money in that account. And so if you put in a certain dollar amount every single quarter, then when come tax time, you have the ability to make that payment to the IRS, and the cash is already built up over the year. So we always want you to have those three accounts on hand at all times. So your cash flow cycle. So this just kind of gives you a little bit more metrics as to, should I hedge towards the 10% or should I hedge towards the 30%, right? So if you take your annual revenue, divide it out by 365, that gives you your daily revenue. And then we want to take that and multiply that by your usage, right? So days inventory on hand and days sales. So days inventory is just the amount of time it takes for your inventory to refresh. So when you get product in, if it takes on average 10 days for that product to get out the door, then that's going to be your days in, your days sales, is how long does it take for that cash to get back to you, right? So if you make a sale and it's next day, you got a pretty good day sale. If it takes a week, 2 weeks, so if you're on the production side and you're not getting your cash in the door till like 30 days down the road, we're going to put some numbers to that and actually come up with an amount that we should be seeing things here. So let's take our $12 million revenue example, divide that out by 365. We have a 60 days inventory and sales, and then we're going to subtract that with our AP sales. So AP turnover is how quickly you can pay your bills. So if you have a bill that comes in and you can pay that bill within 15 days, we consider that just a 15-day period. Typically, it's going to be right around the 30, 45-day mark is going to be your AP turnover. So we're going to take that, subtract those two numbers, and that will get you a total cash on hand that we would recommend you having would be $986,381, right?
So that's a long calculation, right, Brett? Just to say
It is.
10%,
Yeah.
right? So you can really just shortcut it, this whole calculation. A lot of times we've seen, this is a hard conversation to have with a lot of folks that maybe just want a rule of thumb, right? So if you want a rule of thumb, it's the 10 to the 30%,
10
but
to
we
30.
wanted you to know it's not just a number we made up. We actually go through this calculation based on your sales cycle to be able to determine how much cash does that represent, as Brett covered, 1, 2, 3 months.
Yep, 100%. Thanks, Guillermo. So we talked about your operating and your cash reserves. So now we want to talk about your tax reserves. So taxes, what taxes? Everybody's favorite topic. Everybody hates them, right? Nobody likes paying taxes. So we got to make sure that we're saving up for that and make sure that we are keeping the tax man happy. So your tax reserve is going to be that 40% number for your gross profit, right? So for the cannabis space, we're going to take the 5.4 million on your gross profit number. Because most of your operating expenses aren't going to be deductible, that's the number that we're targeting. So we just take that 40% mark and come up with a tax reserve of 2.1 million. Divide that by 4 equal payments for your quarterlies, and we come up with a $540,000 quarterly deposit rate to that account. So here we see what we're talking about. So if you're putting in $540,000 every quarter, and then when it comes up for April 15th, you'll have the money in there to be able to make that tax payment to the IRS, and then we just start that process all over again, right? And then we can having a $2.1 million balance. If you're under or over, it's a lot easier to make up $160,000 than it is to make up $2 million, right? So we want to make sure that we're constantly saving for that and putting that money away.
Yeah. And Brett, you took that against the gross margin, not the pre-tax number as you would see for a normal company, right? And I
Correct.
think most people are wondering, well, what about the reschedule possibly happening this year? Will 280 go away? As well as you've seen a lot of news with the major MSOs that have filed amended returns, and now you're starting to see more of them. So even regardless of the reschedule, you're seeing some activity in some tax position that some of the larger companies are taking. Some of that, some are saying they're reserving only an amount as if they're not a 280E. Some companies are, this is more in the public publicly traded companies, but it gives us some insight how everyone's treating this. Some are reserving as if they are still a 280E company. And so some of this just depends on how much risk you're willing to take and reserving. But the most conservative approach is to do kind of what Brett said, is to reserve on that gross margin. You'll have extra cash. But I just wanted to point out there is a lot of companies out there that are already being successful in challenging 280E. We'll see what happens. In any case, the reschedule will help that go away in the current year. But if you look all across the sector, the larger companies are handling this a multitude of ways. But we recommend the most conservative approach here is to make sure you have that cash available at the end of the year to pay your taxes.
Yep. I did see that article come through. They haven't, so some of their returns got rejected, right? Some of them were accepted. But one thing that I will know is they didn't disclose whether that 280E refund was from the federal government or whether it was from the state. So a lot of states, Missouri just passed here, I think this year, to decouple from 280E on the federal level. So now states are going, cannabis retailers in Missouri have the ability to go back through and amend some of those returns to get some of that money back on the state level. So that's important to pay attention to as well, right? If your state is making adjustments like that, make sure you're staying on top of that news so that you can make those adjustments and get some of that cash back if you're able to.
So. Yeah, and that was the Trulieve one that you mentioned, Brett, and that one is not so clear whether it's federal or state. So yeah, it could be all state, but some of the newer headlines, they're specifically stating that it's related to federal. So really, time will tell on what's the basis for all this approach, and everyone is speculating. Again, I'm not a tax attorney. There's some webinars out there very specific to this issue. But here we're just trying to kind of decipher what's the most conservative approach or how to do. But yeah, to your point, some of these
most important thing is just pay attention, right?
Yeah.
So, yeah, cool. So having poor cash planning can lead to lost opportunity. So if you don't have those cash reserves available and you want to go hire somebody, but you're not going to see a benefit on the sales side from that for 3-4 weeks, you may not have the margin to carry that salary for that person for that time, right? The other, if you have product that you can buy at a discount rate, but it's only available for a certain period of time, for whatever reason, you have the cash reserves, you can go buy that product, and all of a sudden your costs come down for that. So just not having cash on hand, not planning for those opportunities can just lead you to lose those opportunities. So we want to make sure that we're planning appropriately and keeping that in mind as we're going through. So.
Thanks, Brett. So let's take it over into financials. We mentioned 4 buckets. Brett just covered cash. We started with cash. It's one of the most important, right? But all these work together. And the next question is, what should your financials look like? Our clients love the benchmarking that we do because as a business owner, you're like, I'm doing 10%. Is that good? What's everybody else doing? So as a cannabis retailer, you want to be at that 15 to 20% net income. That's the golden standard. But I'll go ahead and say that regardless of your business model in cannabis, that 15 to 20% is what's really going to attract capital, but it is also benchmarking that you're doing all things successfully, and you'll be able to build cash flow at a 15 to 20% net income over time, especially after fingers crossed if 280E goes away in the current year. And so the financials, it's what really sets us up for a consulting relationship with our clients, and it's also the foundation for raising capital, and to be able to look at that historical information to be able to develop your metrics, right? And so let's get into that. But before that, where did we come up with this 15% number? One thing you can do is, if you follow the public MSOs, they talk about gross margin. You can see what the best performing margins are in that space. But we also look at, this survey that MJ Biz did, and that shows you that margins over the last 4 years have been right at the 20% for cannabis companies that are profitable, but you see that only a third are actually profitable. So we'll go into what are the metrics at the very ground level to get to this 20%. And so if we go into the next slide, let's just look at an overview of what should your financials look like. Very high level. The three financial metrics are gross margin, overhead as a percentage of revenue, and then net income, the 20% that I just mentioned. But if we break that down further, you may be like, well, how much should my rent be? My rent seems kind of high. What are other retailers doing? Or is this efficient use of overhead, right? So let's just go one by one. What should it look like and what should those percentages be? Oh, go back one, Brett. So let's just look at a retailer doing 12 million in revenue. If we take the cost of goods sold, this is just the cost of the product from the brands, from the vendor. Usually that cost is marked up about 100%, right? So that gives you a gross margin of 50%. Here we're saying, okay, there's probably some discounting. We're going to go down to a 45% margin. So anywhere from a 40 to 50% margin is really excellent at the retail level. Some pieces of the revenue of the supply chain do better, processors, wholesalers, but here we're talking about retailers. Um, Going up one step, the revenue, your discounting would be in that line item or separated out. It's not part of your cost of goods sold. So if you're discounting your product, you'd have a separate line item and you really want to track where you're at. I saw a report from Dutchy that I keep referencing that speaks to the level of discounting in 2023. It was pretty high. It's somewhere above 20%. And so overall as a sector, there's very massive discounting going on, and you want to track where you're at in relation to that. And then that's gross profit. So that's that 45% number you see there when you take revenue minus the cost. And then your overhead is really three buckets. That's admin, marketing, and facility. And overall, maybe somewhere around 25 to 30% as a percentage of your revenue is really where you want to be and how you know you're using your overhead efficiently. So that's what gets us to the 21%. And then if you take that federal tax at the gross margin level, where we talked about in Brett's cash presentation piece, gets you to that 2.1 million. So you can see with 280E, you're at a 3% percentage after tax. That's really rough. But if 280 goes away, that 3% gets somewhere around 10, 11%. So much better overnight improvement if the reschedule happens. So let's go ahead and just kind of break it down further. Um, I'll go through this really quickly, but within your income statement, you'll have different categories for the form factors. So flower, pre-rolls, concentrate within revenue, each will be a separate bucket, as well as in your costs, so that you can track what's my profitability on flower, vape, concentrate. Pre-roll is a growing category, but is it profitable? And so these are the decisions you want to be able to make as you're not only meeting the consumer demand, but also ensuring that these various categories are profitable for you. And Brad, knowing in your experience, you've done a lot of work just organizing these income statements and making sure that cost is hitting in the right buckets, right? I mean, do you see this a lot, like that's like totally messed up and you have costs going where it's not supposed to be?
So that's important. But the biggest thing that I see is it's easy to get carried away, right? So it's easy to have 40 different revenue lines for each individual product, or a cost of goods sold line for each individual product. And while that can be useful information if you are keeping up with the data correctly and tracking it appropriately. Most of the time, what I see is it just gets messy, right? So you want to make
Hmm.
sure that you have a core group of categories that you are tracking, and then you have a core group of revenue items that you are tracking, and try to group things together that make sense, so that you, rather than having everything listed out on your financial statement, it just gets difficult to read. Utilize your POS system or your inventory system or whatever, to better track those metrics on inventory costs and things, rather than trying to put them into your financial statements. So that would just be my caution to you. I've seen a lot of messy financials over the years, and it can just get easy get lost in the sauce on that. So
Yeah. And it's pretty straightforward, right? I mean, you know your SKUs for flour, you know your SKUs for pre-rolls. So, with the right people in the room getting this information together, you could definitely just simplify there, as you mentioned, Brett. So, yeah, just moving along. Um, just you can just go ahead and go through. So, what would be in your? Oh, go back one. Um, so you could have different brands within your COGS. Your discounting is not included here, but just wanted to point out, these would be all kinds of SKUs going into one line item. Okay, go moving along. And then your marketing expense, what would be included in there? If you could just go ahead and go through all of them. I was just in Missouri for a MoCan event and just driving down the highway. I mean, there is every billboard that I see is something related to a dispensary. So there is a lot of spend going on with, vendors like Clear Channel, Lamar, and it's pretty high price. And so here we have a low number, but over time, marketing is just getting dollars in marketing are getting higher and higher. So the 1% number probably a little bit low here. Um, but the marketing expense is like the billboards, the weed maps, promotional events, whereas your wages is your admin, banking fees, cost of moving money, and your facility is your security costs and your rent expense. So really those three buckets and organizing your income statement with those buckets is the right way to do it. And one question we get a lot, and that's why I threw it in here, is, you got your wages, but you also want to be able to, as I mentioned, a lot of what we do in this forecasting is we get the question a lot, like, I want to hire one more bud tender. I want to hire a general manager. Well, how much production do I need to be able to cover their cost? And it's not just the salary here. You'd want to look at the salary plus what employer costs you're going to have for that employee. So looking up the any kind of local taxes you may have, but Social Security is at the federal level and Medicare. We put the percentages there. You want to at least make sure that you capture that if you're providing any benefits like 401k or health insurance that you're matching premiums, all that costs, you want to add it together to come up with a burden rate, So that just means you take up all these costs divided by the annual salary of that employee. And you could say, okay, on average, I'm spending about 30% extra for each person I'm hiring. And that way you can forecast what it's actually going to cost for you to hire one additional person. And how much I really harp on the labor costs here because that's really the decision other than opening additional stores that you're going to want to look at, okay, what information do I need to look at to see if that is a good decision? Um, and here's a metric that you want to track is really your revenue per full-time employee. According to MJ Biz, the average in the industry is about 192,000. So if you're looking at that income statement that we just saw, 12 million in annual revenue, divide that by your total employees, and then you can get a range of how efficiently am I using my labor, right? And so this is just kind of a wide metric that you can look at and see how your labor cost is tracking. And then production. So we've covered two buckets, how to organize your financials. And now this really takes us into We've talked about cash. We've talked about financials, developing the actual metrics because gross margin, net income, those are historical. And these are the metrics that are more of the lead indicators, the actionable uh, items that will lead to higher gross margin and higher cash. So we kind of work backwards here, but this is the ground level. The most important metric in retail is basket size, not to be confused with AOV, and there's a lot of terms that are being used. So we'll define it. It's your total sales per month divided by the number of transactions. That is your average basket size. So you at least want to make sure that you're calculating this and tracking it month by month to see how you're performing. And what influences basket size? It's the number of items per basket and the price per item. So you could be selling more items per basket. Your prices could be coming down. Your prices could be going up. Most likely, prices are coming down. That was the overall trend in the industry in 2024. Lots more items being sold, a lot of discounting. So the price per item was lower. So you didn't see really basket size improving year over year. But again, this is just national data. So where's your state performing? Where's your local market performing to see what your basket size is looking like. And this is just some historical information. So if you look at California, they're in the 26 $26 range of price average item price per market. And so this really influences that basket size. If your items are being discounted or just prices are coming down, basket sizes are coming down, revenue is coming down. And so this is the overall trend. This is only through 22, but it's really has continued or flattened out, especially because these are some of the more established markets. Newer markets are performing much better, but again, look at this and see how, where you're performing in relation to the market.
One thing I also point out is if you look at the chart, the early time period where this starts is COVID, right? So
Mhm.
people are at home, they're buying more, they're more comfortable using more often because they're not having to travel, not having to go into work, those kinds of things. So um, retail prices really hit their peak during COVID. But now we're starting to see those margins come down, basket sizes being a little bit lower, things like that. So those are some trends and stuff to keep an eye on as well.
Yeah. Will there ever be any kind of event like that? Probably not. So we're just really focused on how we can, work, what can you control? And that's going to be your pricing and some of the things, examples will come up here next. And this is just another one. If you want to look at it by flower, average equivalent price of flower, you just also see a decrease across some of the legacy markets. And then moving along, this is okay, we follow that on to basket size. And so how has this affected basket size? Well, those prices, you see $30. If you buy two items, that's 60. You calculate the number of transactions, just how we calculated basket size early on. So revenue divided by total transactions gives you this basket size. And again, this is by market, and it's come down not so much because of the price per item, because of the number of transactions, but because of the price per item has come down. And again, this is more historical, but if you look at what happened last year, uh, same thing. You see revenue being flat in a lot of areas, in a lot of markets, despite more items being sold. So what does that tell you? It's a simple, right? It's just the items are being discounted. Consumers are buying more, but at a lesser price. Um, and then um, we can look at some better performing markets, like newer markets like Maryland and Illinois. I don't have Missouri on here, but I'm sure if we found the data for that one and put it in the slide, it would be up in the $100 to $70 range, somewhere around there, because there's our new healthy markets. And quite frankly, once we show the financials, I wonder how some of these companies doing 32, you can't do enough transactions to grow profitability at a $32 range. There may be some one-offs there, but it's really difficult to be profitable over in this 30 to $50 range. But when you get to 70 and above, that's where you can start to actually hit your 15 to 20% net income number if you're managing your overhead correctly. So we said earlier, we're not just going to present this information and define the terms without actually going through what are some of the things that you can do to increase that basket size. How do you get it from that 30 to that 90? Maybe that dramatic of an increase isn't possible, but we want to go through those, what do we call them? Levers, right? That we can move this and increase profitability. And even a small change can increase, it could turn out to be a lot of dollars over time. So let's walk through that in two ways. To increase that basket size is cross-selling and upselling. So suggesting additional products from a different category will increase the number of items, but upselling increases the actual dollar value. Um, one is not better than the other. It's just the appropriateness and education of the frontline people to be able to determine, who's the right consumer who will be likely to buy more items or to buy step up into a higher price category. And if we move along, we have an example here of how to upsell into um, into a new category, right? And so pre-roll, fastest growing category, especially among millennials. Here's where we're saying that, let's just say this is a $4 item. Um, Same number of transactions, right? We're just adding an item to a basket, and if we're 10% successful on a conversion of we ask 10 people and every one out of 10 people, customers says yes, this increases basket size from $61 to 61.60, right? It doesn't sound like a lot, but just that small growth for this example builds revenue by $120,000 per year or more than $500,000 over 5 years. So if these are behaviors that can just stick long term, it starts to build revenue and profit without much incremental cost, right? Because it's just something you're converting. So there's an example there of how actually putting this into practice increases your profitability. And so let's summarize what are the three levers on the retail side? Well, it's really going to be optimizing your discounting, making sure that you're only discounting when it's generating additional sales and additional profit, and increasing that basket size, as well as bringing in more people and increasing daily transactions. And so those are the three levers that are really going to increase sales and that you have some level of control over, right? Discounting, direct control, daily transactions, it's around your marketing and getting more people into the retail location. And this one was just an example of how in some periods, Brett, you mentioned COVID. So in 2020, you just had really high basket sizes but low transactions, people stocking up, right? Could there be some of those, maybe not as dramatic as this, but to some degree, seasonal times within your business where you're having lower transactions but bigger basket sizes? That would mean you want to have the right amount of inventory. And so having this information, these seasonal trends could really help you uh, manage your cash as well as making sure that you have the right product mix for these seasons. All right. So we're about 10 minutes. Let's go ahead and start running through these, Brett. Let's go going on to the next slide.
It'll advance. There we go.
hmm Yep. And then we just went through all that and just to show that it's pretty erratic, right? The point here is just that pricing has been erratic and just goes to show you that there's not a consistent strategy and how a lot of retailers are really struggling with their pricing. And so these concepts are really important to apply. It makes it difficult to forecast, right? So moving along. Um, this is just the summary of everything we've talked about. And so we talked about non-financial drivers building a forecast. Here it's basket size and transactions. And using this example, this is a 4-year forecast and how you can take your basket size, look at your transactions, and then forecast your revenue. And so if we're saying $71 is your basket size, and you're doing, if you go to the next bar, Brett, you're doing 169 of transactions, you're at 12 million in revenue. Um, and you walk that across to 2026. If you're improving basket size, improving transactions, what I want to demonstrate here is how you can get from a net income of barely profitable to about $2 million by increasing your basket size just by $10. So in that earlier example, we just made a little tiny incremental change, right, to increase it 60 cents. But to get it you know, to get profitable, we may need to do $10. And so this is where it really helps you determine like where do I really need to be in terms of transactions and basket size to get to a profitable number because what we can see here is that even at a 21% tax rate, um, you're not really making cash. You're not building cash after taxes unless you get to that 15 to 20%. And even then, it's a really low margin of 2%. And that's what I'm looking at there is the very final year where you just see the 343,000 uh, when you grew your revenue to 15 million. And then you're just kind of walking through how we got there. But again, the very last line item there is if we want to, in light of everything that's happening right now, the reschedule, you can just see the difference between a company that's paying 280E taxes and one that is not. Huge difference. It's several million dollars over this 4-year period. So you hear the big MSOs filing claims of 50, $100 million. But even for a $10 million company, I mean, you're talking 3, 4, $5 million of extra cash into the business uh, post, 280E if 280E goes away. So it's a huge difference there. And what the gross margin looks like in the financial section, we said, you know, 40 to 50% is an ideal margin. But if you're in that 35%, your overhead is about 30%, um, you see that you're really still at a loss. But as we go into a 40% margin, and again, remember those basket sizes that we were showing on the earlier slide, that's really where you need to be to start to get into the positive, right? It's a 70, 80 million, 80 basket size, and you can achieve that with a 40 to 50% gross margin to start to get positive over here in years 3 and 4. Okay, so just moving through these. Here, I think what the main point was just that discounting and gross margin. Uh, 15% would be a normal number, but you really want to limit your discounting. And this is just really summarizing uh, the income statements that we just went through. So, and then lastly, we got about 5 minutes here to wrap up. So we're going to go over the customer metrics. And then again, the customer metrics is if you think about a pipeline in any business, uh, let's just say you have a website, number of clicks and then a conversion, um, number of people in your store and then a conversion. Those are all leading indicators that are getting you to how much your sales will be, right? So it's really being able to look at what's happening right now and then what the results are going to be. So that's what pipeline and customer metrics are all about. Um, for a company, flipping houses, I mean, could you flip Could you sell 30 houses if you only have two houses in inventory this month? Probably not, because you need 60 days to make the sale, right? So there's a sales cycle, and what you have in inventory right now, what your customer retention is right now tells you what's going to happen in the future. It's the same concept in retail. If you are acquiring so many new customers on average, or you're retaining only a certain percentage of customers on average, that will tell you kind of what your sales will be the following month, right? And so the customer retention rate is one of the areas that we want to look at and one of the key metrics. And that's customers at the end of the period minus your new customers divided by your customers at the start, and you get to a percentage. And that's your customer retention rate. In cannabis, it's pretty low. People are hopping around, but in any case, you want to track that customer retention rate, and it'll be your total cost of sales and marketing. Some folks exclude or include a few specific items out of this, but I'm just going to kind of generalize here, divided by the number of customers that you've acquired in that period. Now, sometimes it's like, what if a customer came from a referral? That's very common and stuff. So it's nuanced. Do you want to make sure that you're looking like at the data and putting some common sense on top of that? Because not all of your new customers come from marketing. There's a lot of referrals going on, but this helps you understand how well your marketing dollars are being spent. Going back to that financial statement, we had that marketing um, number in there. As that number grows, we want to make sure that that marketing spend is efficient and is generating new sales. Nothing wrong with increasing that spend so long as you're seeing the revenue coming in. It measures how much money each customer is bringing in. So customer lifetime value, moving on to the next metric, is the total lifetime value of a customer. So let's just say that we're back to that $71 basket size that we looked at in the financial statement forecast, and they purchased 14 times in 1 year. That means they have a customer lifetime value of 994. So if we keep going, we want to see, well, how much money did we spend trying to acquire this new customer? And the answer is, well, you got to analyze it, the customer lifetime value divided by your customer acquisition costs. And so 3.3 would be a good number there if you're spending more, or just the lifetime value of the customer is just not there. Maybe you need to look at other marketing channels, or is just not very efficient use of your marketing dollars. So just to summarize, because we went through that pretty quickly, we're getting like to 3 minutes before we got to wrap this up. Customer retention rate, your customer acquisition cost, and your customer lifetime value are the main metrics that you want to track within the pipeline area, and then the ratio. So we're getting close to the end here. You know, we talked about a lot. We went through it really quickly, but we want to just summarize that, profitability in cannabis is really tough. We saw that 1/3 number earlier in the presentation, but all this information is really your road signs. We talked about leading indicators and how this information can kind of help you get in the right direction, as long as you're headed in the right direction. And the road signs to profitability, we talked about basket size, number of transactions, and the pipeline metrics that we just covered there. And so just to summarize, these are the four areas. We covered all four areas. They all work together. It's really a concept, and what's most important is just to keep these concepts simple, keep applying them, keep learning, and most importantly, benchmark around your area to see how you are performing. So that really wraps it up. Before we go on, Brett, do you have any final thoughts before we wrap up?
No, this was a lot of fun. Guillermo's really educated in this space, so he does offer free consultations and stuff like that. So I'd encourage you to reach out to him. Just scan the QR code there on your screen, and he can walk you through some of these metrics and things like that. So I didn't see any questions come through. So if anybody has any final questions, go ahead and pop them in there. Otherwise, schedule time with Guillermo, and he can walk you through this in a little bit more detail.
Yeah, I think that wraps it up. Brett, thanks for being on the webinar. Appreciate having you
So
here.
had a lot of fun.
Um, Thanks for everyone listening in. And I think that's a wrap. And as you mentioned, yeah, just feel free to reach out. This is an ongoing conversation of kind of how we going to navigate through the year and get to profitability and grow good businesses. But appreciate everyone being on the webinar. And that's a wrap for today.